We'll go live now to House Ways and Means Committee Chair Congressman Kevin Brady. He'll discuss potential tax policy changes under the Trump administration. This is live on C-SPAN 2.
So at Ways and Means, so he's been
I'm not
Well, good morning, everyone. My name is Tim Palenti. I'm the CEO of the Financial Services Roundtable. Welcome for this discussion. We're glad that you're here and participating in trying to advance dialogue, discussion, and hopefully progress around one of the most important issues facing our country and one of the most important issues for working Americans as they try to better secure their financial future. We're really delighted this morning to be joined by one of the key leaders of this discussion and this movement forward, and that is the chairman of the House Ways and Means Committee, Chairman Brady. I'll more formally introduce him in just a moment, but as you know, he's been a champion for policies that are going to stimulate economic growth, but also policies that are going to give Americans a better shot at a more secure financial future. This is an important issue for a variety of reasons, but let me just give you a couple of statistics that I think tell the tale in a very dramatic terms. In a recent study, just 37% of Americans had enough resources to be able to address even a $500 to $1,000 financial emergency. I mean, they don't have enough of a cushion set aside to address even a $500 or $1,000 emergency. And so when you hear about Americans living on this stressful edge of not being able to make ends meet or be able to address even a modest bump in the road in their lives, the statistics bear that out. And it's not just a statistic. This is a source of great stress and worry and challenge for so many people across this country. Another statistic, the Pew Charitable Trust recently reported that 1 in 3 Americans have no savings at all. 1 in 3 Americans have no savings at all. It's just remarkable. And we also have more than half of the people who responded to a recent survey saying they have no excess resources beyond what they take in week to week or month to month. And so there's a lot of people in the country who are able to take advantage of some of the wonderful programs and things that we have offered through the current tax code and the like, but there's a whole bunch of our fellow Americans who aren't able to participate, either because of lack of capacity, lack of understanding, or lack of access. And Chairman Brady, I know, and his colleagues are focused on these issues, and we hope through some of the things he'll be talking about today that there'll be economic growth, but also enhanced opportunities for those who aren't able to access the system and have a better financial future. At the Financial Services Roundtable, we've tried to address some of these issues through a subgroup called the Financial Security Coalition. The Financial Security Coalition is focused just on financial security issues, including retirement security issues. It covers the waterfront on a variety of things that you might assume are underneath that. But 3 of the main tenets of the Financial Security Coalition is trying to advance policies that promote savings, income protection, and financial literacy. All 3 are important. We try to tackle all 3. And if you don't know about the Financial Security Coalition, we hope that you'll check it out on our website and learn more about it and perhaps become involved in it. In terms of Chairman Brady's presence here, obviously he is in such a key part of what's going to happen in this Congress and with the administration, hopefully advancing historic tax reform. Chairman Brady's been working on this and thinking about it for a number of years. And of course, in his position as the chairman of the House Ways and Means Committee, he's in a position to drive it forward in a very important way. The blueprint that he'll be talking about today, and I guess the working title of the earlier version is A Better Way, is really focused on taking a look. Our tax code hasn't been fundamentally rewritten, as you know, since 1986. And here we are in the year 2017 with a lot have changed technologically, culturally, socially, economically. So the code needs to be not only updated, but it needs to be modernized in a pro-growth, pro-investment, pro-capital formation, pro-capital deployment way. with a particular emphasis on what can we do for working Americans. And I know that's the chairman's focus. We're delighted that he's here, and I would like you to join me in welcoming him this morning to give his remarks.
Thanks, Jim. Thank you, Chairman. Governor, thank you very much for having me here today. Thank you for the role of the Financial Services Roundtable, the board of directors. You've got a talented team here as well on board, and who are continuing to play with the Ways and Means Committee a key role on financial security, on savings, on how capital formation. So thank you for your leadership and for the Roundtable's leadership as well. When we began this effort really more than 5 years ago, but accelerated dramatically last year under our Better Way agenda. And the goals we set out, that I set out for developing our blueprint were this. Rather than a tax code designed merely to wring money from you, which is what we have today, we're proposing a tax code built for growth, literally designed to grow jobs, wages, and the economy of the United States. And while doing that, leapfrog America from dead last among our competitors around the world back into the lead pack as the most pro-growth place on the planet to make that new investment, to create that new job. And those goals, those of growth and leapfrog to the lead, have really driven every decision we've made throughout the blueprint. But there is behind that sort of my belief, and it goes to the financial security of the country. I still think perhaps the greatest threat we face is a government that lives beyond its means and consistently does. You know, I'm convinced spending cuts gets us halfway back to a balanced budget, maybe even more. But to finish the job and actually begin paying down the national debt, we need a much stronger economy. We need people back to work. We need them in good paying jobs. So growth and leapfrog is a key part of this. But also as we do that, I think we can take a big step toward the financial security of our country as well. So let me talk about very quickly the key points of our blueprint, how it ties to savings and investment and financial security in the long term. So we're proposing three major reforms. The first, we propose the lowest rates on job creators in modern history and a redesign of our tax code so that American companies, large and small, can compete anywhere in the world and win, especially here at home. That's the first reform. The second is we go all in for fairness and simplicity, so much so for families and individuals, 95% of Americans will be able to file using a simple postcard style system. And the third reform is to bust up the IRS, to redesign it into a 21st century organization with a singular mission, customer service. And so let me dig into those three a little deeper. The first is on going all in for growth and jobs and wages. So we're proposing the lowest rates in modern history for corporations in all sizes of business, pass through small businesses as well. It is an equal 43% tax rate cut, regardless of size, regardless of structure of your business. And this is a simple principle. We want Washington to take less, so businesses can invest more in their workers, in their jobs, in their future. We propose for the first time full and unlimited investment to be immediately written off. We're convinced that business investment may be the most pro-growth part of our blueprint. It drives Main Street jobs in a major way because being able to immediately write off your purchases in buildings, equipment, software, and technology is incredibly pro-growth. But more importantly than that, this is a major investment in human capital. These are the investments that drive productivity and wage growth and GDP growth. It is one of the missing ingredients, maybe the missing ingredient in the current slow recovery. We don't stop there. We know our businesses aren't just competing on Main Street, they're competing around the world. And so we redesigned our international tax system. We know just as you know what your competitors are doing, we know what ours are as well. They have lowered their rates. They no longer tax worldwide, and they adjust their taxes at the border. So we match them. We propose to no longer tax U.S. earnings overseas, not only making our companies more competitive, but allowing that capital to flow back in the United States to be used for new investment, new jobs, new research, new manufacturing, a key part of our blueprint. But we also know that our competitors from China to Europe, Mexico to Canada, all border adjust their taxes. So they take taxes off their products heading toward the United States, they put it on our products heading into their country. As a result, today, Made in America products are at a tax disadvantage here and a tax disadvantage abroad. And it creates major incentives for U.S. companies to move overseas, whether it's their job, their manufacturing, their research, or their headquarters. In fact, today, because of our tax code, the best place usually to access the United States market is to be outside the United States market. That can't continue, and it won't continue. So we're proposing to border adjust our taxes as well. So imagine you've all seen a theater production where the spotlight starts wide and then it narrows down onto a singular person on that cast. We're proposing to do the same thing with the tax code, to narrow our tax code down to the United States and ask a simple question. Is your product or service consumed in the U.S.? If so, it will be taxed equally at a 20% tax rate. Whether it's produced in the U.S. or abroad, whether it's a foreign company or domestic company, if it is consumed in the United States, your product, your service, your intellectual property, it will be taxed at the same rate, 20%. That simple but powerful reform has significant benefits. For the first time, it levels the playing field between imports and exports. Because today, in my view, U.S. companies, large and small, are competing with one hand tied behind their back. That ends. Equal taxation creates true competition, which is key, I think, to economic growth moving forward. It dramatically simplifies the tax code by moving toward consumption in the United States. So all that foreign country to foreign country, all those issues of transfer pricing, all those decisions of where to put your intellectual property, all these check-the-box approaches, the anti-base erosion measures to try to keep companies from moving abroad, all that disappears because we're moving to a simple principle. Is it consumed in the United States? And if it is, it will be taxed equally. But there's another advantage as well. In combination with the lower rates and no longer taxing worldwide, we have eliminated any tax reason to move your company, your research, your headquarters overseas. In fact, just the opposite. We've reestablished the United States as a magnet for growth in the 21st century, as the best place, one of the best places for that new business investment. It is a key part of our tax reform. We also eliminate the alternative minimum tax and the estate tax as well, which for me, it is still the number one reason family-owned businesses and farms aren't passed down to the next generation. I think it's a critical part of our business reform. So taken together, Tax Foundation estimates these provisions grow the U.S. economy by more than 9%, and just as importantly, grow wages on average by 8%. So we start with a good, strong growth forecast from what we're trying to do. The second reform, we go all in for fairness and simplicity. So for families, for individuals, what we're proposing to do is to flatten out the brackets. When President Reagan began his reform, there were 15 different tax brackets. Today there are 7. We're proposing to flatten it down to merely 3. We lower the tax rates at each level, with the top rate no more than 33%. We preserve more of those first dollars families earn. We're going to significantly increase the standard deduction. Protecting those first dollars, incredibly important to young people and young families starting out, and seniors watching every penny in retirement, critical going forward. But we don't stop there as well. After we flatten the brackets, after we've lowered the rates, after we've protected more of those first dollars, we go further. For the earnings you get from savings and investment, from interest and dividends and capital gains, we cut your tax rate in half again. This may be, that provision on savings investment may be the second most pro-growth part of our blueprint. Because one, we're not a nation of savers, and we need to be. So we want to reward savings at every turn. Secondly, it's incredibly pro-growth in the local community because those savings never just simply go to that financial institution. They are immediately reinvested back in the community to grow jobs, create opportunities in a significant way. So, and for the postcard, we keep in place the elements that most families count on. So we keep in place the home mortgage deduction and the charitable deduction. In fact, we're looking at ways to unlock more charitable giving. We keep it's expensive to raise kids. So we keep the child tax credit and the college tax credits, which we're redesigning, especially on the college side, to make sure that we're rewarding students and families whose kids are going into technical skills, which, by the way, are not only needed, but those are expensive training as well. Then, other than one other provision to help people move from welfare to work, that's it. That's what we're proposing, that fair, that simple postcard approach. And my point, excuse me, to everyone is this is not Washington's tax code. It belongs to the American people. For the first time, you ought to have a say in how you're taxed. So we can put anything back on this postcard you want. We can put dozens of provisions, more than that. We can turn this back into a telephone book if that's what you want to see. But just know, to do that, we have to raise taxes. You have to send more money to Washington and hope you can get some of it back. So we're listening carefully to the American public, American people, about how fair and how simple a tax code do they want to see. And then finally, a simpler, fair tax code demands a simpler and fair tax collector. So we propose to bust up that huge unaccountable IRS, redesign it into three smaller, much more focused units. One, a business unit staffed with business tax experts focused on timely, accurate answers to the questions our business community needs about the tax code. The second one, to do the same for families, to make sure this is a customer service first IRS, and I don't know how many of you tried to call the IRS lately, but you didn't get through. And if you talk to two or three people, you probably got two or three different answers to your tax question. That level of customer service, I guarantee you, isn't acceptable in your organization. It's not acceptable in the IRS either. So we redesigned this focused on customer service. And finally, because we're really tired of hearing about families and small businesses that get in a tax dispute with the IRS, sometimes relatively minor, they'll spend years and years, thousands of dollars to litigate that. And even when they win, they've lost. So we're proposing, in effect, a small claims court, an ability for individuals to be able to quickly and independently get their disputes resolved without having to hire legions of accountants and attorneys to do that. That is what we call our Built for Growth tax proposal. All in for growth, all in for fairness and simplicity, busting up the IRS. At the end of the day, we now, and I'll finish with this point, tax reform, as Governor Plenty said, only happens once in a generation. It may not happen again in another generation. We don't want your children to be sitting in this room wondering when we're going to do tax reform. Our belief is that it is not enough to simply tweak a few things in the tax code and call it a day. We're going very bold on both the business and the individual reforms so that we can grow this economy in a significant way, so we can give people back more control of that which they earn for savings and their dreams, and to leapfrog America back into the lead pack. We know these are major changes. We're anxious to have these discussions. This all became real November 9th, when people realized that America had elected a Republican president and a unified Republican Congress, all devoted to fixing this broken tax code and getting this economy going. So, Governor, with your permission, can I stop and take some easy questions from the audience? Yes, sir. Yeah, Peter.
The revenue neutrality might not necessarily be within the Republican caucus. There's traditionally been, for the last 8 years, rising concerns about massive deficits, as you know, and we're also looking at a budget resolution anticipates another $9 trillion being added to the national debt over the next 10 years. What would your response going to be to the White House with regards to revenue neutrality?
Yeah, so thank you for the question. We're having terrific discussions with the Trump transition team and their new economic team about pro-growth tax reform. That's part of that discussion. We designed the blueprint to be revenue neutral, counting on economic growth. So breaking even in the budget, knowing that this will grow the economy in a significant way. It means we will lose tax revenue in those early years, make them back in later years, and essentially break even within the budget no later than the first 10 years. After that, it creates significant revenue going forward, which helps us with our debt and deficit. So I believe both the most pro-growth approach we can take and the fiscally responsible approach we can take is to break even with the budget, counting on just solid, verifiable economic growth. I've stunned them into submission on this morning. Yes, ma'am. Yeah.
Can you give us a little more insight into what you're thinking in terms of the retirement savings, tax incentives, and structure? You kind of gave some preliminary thoughts in the blueprint, and we're just wondering if you could share some more additional insights in the path you may be taking.
Yeah, thank you. So there's three approaches we're really looking at here. One is lower rates that encourage and reward savings. So if your tax rate is 25%, your savings rate is 12.5. If your tax rate is 12%, your savings rate is 6%. So we go significantly lower on those rates to reward savings. We don't stop there. We're looking right now in the blueprint on how we simplify our retirement vehicles and make it easier for people to save, whether it's at work or individually, whether it's for retirement or education or healthcare. And so right now, we're seeking the ideas of organizations like this on ways that we can create vehicles that are easier to use, that are more flexible, that have higher savings limits. We think that's important moving forward. For example, I think there are 15 different education savings accounts. I know this because I have teenagers and we're saving for college. The cheat sheet for those savings, the tax code for dummies is 90 pages long. Just to look at that, I'm convinced that's too complicated. We're convinced that we can create 3 or 4 bigger, broader, more flexible, more user-friendly accounts. We're looking at the same thing in retirement savings, healthcare savings as well. The third point is that within the tax code, the financial services industry, we sort of put a couple industries aside when we unveiled this in June because they needed more thought, because they had a number of tax provisions that tend to interact. We want to make sure we get it right. So financial services, insurance are 2 of those areas that we're looking at thoughtfully to make sure we've got the right incentives and the right provisions in place, because they are sort of a different animal in savings and long term. They have a different approach than many businesses do. We want to make sure the tax code actually encourages stability in those industries for the long term. What do you think?
Just given entitlement, the challenges facing the entitlement funds, we definitely feel we have a very powerful and strong role to play in helping American families secure their financial future. And so I thank you for those remarks. And I think the biggest takeaway from the blueprint was that you wanted to maintain the current incentives and maybe, continue to look at simplifying the system. And we have engaged with your committee on some of those thinking to kind of help make it a little easier for individuals, families, and businesses as well.
The good news is we've had a 5-year deliberate running start on tax reform. And we've been forced to be able to engage over a number of years in developing the blueprint. As we finish this out, as we send it to joint tax to be scored, as we begin the process forward, So we're making decisions in those areas in the very short future. And so thanks for being engaged. Yeah. Yes, sir.
Chairman, thank you very much. I'm Greg Wilson, small businessman and financial services consultant. I applaud everything I heard this morning. The question for you is, as you think about our tax system and the fundamental overhaul you're proposing, I've always considered it upside down. By that I mean we reward credit and leverage, we penalize savings and investment. You've got a very positive approach. Wonder if you ever consider getting rid of all tax on all savings and investment to promote capital formation and growth. And if not, and I understand reasons why you may not be able to get rid of all of that, have you considered a holiday for the next 3 years to really jumpstart growth in a low or no tax rate environment?
So don't tempt me with the holiday or the lower rate. The truth is, if I found extra money, I'd lower that savings investment rate even more. It is incredibly pro-growth, in ways people can't imagine. So I would go even further that direction. We have to do more. I think one of the big changes we're making, because to make sure it breaks even within the budget, you can't keep all the special provisions in the tax code and lower the rates for everybody. So, we've gone bold on the reforms because many of them eliminate the need for those special provisions. Not all, but many of them. And so one of the big changes is on interest deductibility and expensing. So we are taking the tax deduction away from shifting it from the source of funds, in this case debt, and applying it to the use of funds, business investment, equipment, technology, buildings, all that drive worker productivity. That is a big change from where we are today, to equalize between equity and debt, to no longer have a tax preference for any type of financing, and to apply that to the growth, the Main Street job growth. So we know these are big changes. So we're listening very carefully to businesses and industry that in the past have relied upon that. And we're exploring ways to smooth that transition out. We don't expect businesses and models to change on a dime. We know there'll be transition periods. So right now we're engaged in very constructive discussions with businesses and industries on how best to do that in a very pro-growth way. So again, stay engaged. We are looking for and getting that. The good news is we're getting terrific input on how to make those provisions work. So you bet. Yes, sir.
Some of us have been in the business of retirement plans when we remember tax reform in 1986, and with all the good positive things that came from it, it wasn't very kind to retirement plans. It paid for a lot of those reforms by lowering the limits, restricting how much people could put in these plans. Retirement plans are where Americans save, particularly middle Americans. And a lot of times, if they have access to that plan, it's because their employer, their small business owner, has the incentives to not only set up a plan, but to put their own money in that line. It's hard to turn this into a question other than to say, I would ask that you keep that in mind, and keep in mind that those incentives for business, for small business, is about setting up these programs and giving Americans a chance to take advantage of the things that you're talking about. So.
Amen to that. But secondly, you'll see throughout the blueprint the direction you just described. We're looking at rewarding more savings, looking at how we can make it easier to save, again, at business or as a family. We're looking at increasing limits, creating more flexibility for use. Again, driving, and it is great for us as a country in the saver side in financial security. It's great for the country from the economic side as well. So I think we're headed the same direction in that. Yeah, thanks. Yes, ma'am. One more question? One more easy question? Yes, ma'am.
How are you handling worker classification in tax reform, specifically independent contractor status for?
So specifically in which part of the code?
Let's say financial services.
Yeah, so to my, let me check on that. To my thinking, there won't be many changes in those areas. If you have recommendations that go, one, all in for growth, two, leapfrog America back in the lead pack, and reward savings investment. If you've got recommendations that fit in our principles going forward, we'd love to hear that. Okay, thank you. So we still have a great deal of work to do. Clearly, the Trump administration and the new president is making tax reform one of his top priorities. You'll see action in 2017. You'll see House and Senate Republicans moving forward in a very pro-growth way. This is a tremendous opportunity. We also know that it is politically difficult to do tax reform. I'm convinced if you just leave this to Washington, it will be difficult to do. Unless we engage small business people and business leaders from around the country to weigh in on the need to do tax reform, this will be even more difficult. The truth is, tax reform can't please everybody. You know, there is no perfect way to tax, but there are proven ways to grow this economy. There are proven ways to leapfrog America back into one of the best places on this planet for new investment. That's the direction we need to go. We're going to need your engagement and ideas and support as we do that. Thank you very much. Appreciate it, Tim. Governor, thank you.
Appreciate it. We are very fortunate to have somebody that seasoned, wise, pro-savings and pro-financial security leading the Ways and Means Committee in the U.S. House. Thank you, sir, for being here this morning. We're going to transition now to the panel discussion. Jill Hoffman, who's one of the leaders in our Government Affairs Department, is going to come forward and facilitate a panel. She's got 3 terrific panel members that she'll introduce in due course. But this part of the discussion is really going to focus on financial security and retirement security, getting a little granular and specific about that area. Jill.
Thank you, Governor. Good morning, everyone. We are pleased this morning to have you all at the Financial Services Roundtable to discuss a topic that I think we can all agree is critically important for Americans' financial security and really that pro-growth perspective that the chairman just laid out. We have a panelist joining us in just a moment, so it looks like we have a little microphone issue here, but I'll go ahead and start to announce. So we have Chris Marks, who is the president of Retirement for Prudential Financial. So we appreciate you being here. And we have Greg Burrows, who is the senior vice president of Retirement and Income Solutions for Principal Financial Group. So thank you, Greg, for making the trip from Iowa to be with us today. And we have Lenny Glenn, who is the director of public policy for Putnam Investments and Empower Retirement, who has really been, with Bob Reynolds at the helm, has really been a thought leader on many of these issues, and actually will have a book coming out on this later this year. So we were thrilled to have the 3 of you here with us this morning to talk about this important issue. A little tricky. So we just had the chairman talk about tax reform and savings and growth, but really, you know, you all focus on long-term financial security and retirement security. So we'll start with you, Chris. How important is the code to really spurring savings and investment?
Oh, I think the code is critical. You know, if you think today we've got probably 80 million households that have saved in the order of $25 trillion in defined benefit, defined contribution plans, IRAs, annuity products. Much of it supported by the tax incentives that are given to employers and individuals. And, you know, we have 100 people in the field talking with individuals every day about enrolling in their employer-sponsored plan. And we see the difference it makes when they realize that there is a tax benefit to enrolling in that plan and saving for their future. It's very important.
And let's bring in Greg. So when you think about what the mic, hi, sorry about that. Greg, as we think about, you know, in the context of tax reform and what the chairman was talking about and the types of steps that they need to take as part of their efforts to really get more Americans saving, going back to the numbers the governor brought up earlier about how people are not really prepared for the long term. From your point of view at Principal, what are the types of things they can be doing in tax reform to really get savings going?
Well, I was very encouraged by the chairman's comments this morning, and one thing he said struck me, which is we're not a nation of savers, but we need to be, and there's a strong recognition there, which was terrific. We serve 40,000 employers for retirement, 5 million individual workers throughout the country, and as a result of that, we spend time with them and understanding their perspectives. And 3/4 of employers believe that tax incentives are the most important aspect for individual workers in retirement.
2/3 of employers have indicated that if incentives were rolled back or diminished, they might be less inclined to want to sponsor plans. So the core of that is tax incentives are critically important for the American companies and American workers. The other important aspect in this conversation, at least from our perspective, is that we speak about these incentives as expenditures in our federal budget. The reality of it is they're different. They're very, very different. They're not expenditures per se, they're deferrals. If we look back at probably, I think it was 2014 or so, in the budget, we may have had about $150 billion worth of expenditures that were scored in the budget. What's really not recognized is there was nearly $130 billion of tax revenue that was raised in that year as distributions come out of retirement plans. With 20-some-odd trillion dollars of retirement dollars in the marketplace and growing, that tax expenditure is going to continue to grow. We've done some work at the principle that kind of looks at, we believe over a 40-year work span, every dollar saved and deferred actually can materialize in $4 of tax revenue in the future. So we really need to change the discussion from tax expenditure to tax deferral so we can compare the right things.
And Lenny, I know that Bob Reynolds and you guys at Putnam and Empower Retirement have also given a lot of thought to this topic, and so I'd like to ask you for your thoughts as well.
Sure. I mean, to echo what Chris said, the code is absolutely the DNA of the retirement system in the country. There's a reason why we call these things 401k, 457, 403b. The code is behind the growth of this system and supported it all along. And we think the way that it's calculated, the way it's scored, as Greg pointed out, is erroneous and needs to be corrected. I mean, the simplest comparison I could make would be, imagine you give me $1 and I keep it. That's an expenditure. You give me a second $1 and 2 weeks from now, I give you back 50 cents or $1. Or $4. Are those transactions exactly equal? Well, obviously they're not. But if you had a 10-day window to judge, you're out $2 at 10 days. And we actually escalate that absurdity to guide our budgeting on retirement savings. So we wind up pitting personal solvency of working Americans and national solvency of the budget against each other, when in fact we believe, as Greg would argue, that they reinforce each other. And in fact, the flows from from millions, tens of millions of American savers providing long-term patient capital flowing regularly through K plans and IRAs and so on, that is the lifeblood of the American capital markets. And we believe it can contribute to increased growth. And it in a tax reform, every time they come around 30 years ago, there was some very negative impacts on retirement savings. We don't want to see that happen again this time, and I trust the chairman recognizes that very well and understands the role that increased savings in America can play in increased growth in America. That's ultimately the long-term solution to the budget challenge.
Thank you. Well, thank you, Lenny. And let's bring Chris back into the discussion because Lenny brings up an important point, and I think Elaine, the audience, was talking about this earlier as well. The way that savings and investments fuels the economy, fuels markets, fuels liquidity. I'm sure Prudential has a few thoughts on that. Would you like to expand on that, please?
Yeah, I mean, this is the lifeblood of capital markets. I mentioned the $25 trillion that are in these plans. This is being invested in a variety of ways, driving growth in the economy. And, I think it's also important to recognize that we've got a strong foundation in the current retirement system, a lot of progress made since 2006 with some of the reforms there, and it is a combination of the tax treatment afforded to employers and individuals, as well as some of the other elements
that such as the adoption of automatic enrollment practices and contribution escalation practices that have really driven a lot of that savings in the last 10 years. And this is where I think we can leverage that foundation. We've got that strong foundation, very encouraged by the chairman's remarks, that incentive will continue. And if we can strengthen the adoption of those features, those automatic features, if we can address the coverage gap that the governor mentioned here, where we have, half of the working population, particularly those in small business, who don't have access to an employer-sponsored plan, have access to payroll deduction and professional investments and perhaps an employer match. Those are powerful forces to drive that pool of savings and that contribution to capital markets even further.
Well, and I'd like to bring Greg in on this as well, because employers to adopt plans, and you mentioned small employers, and getting small plans to be more readily available. You mentioned the Pension Protection Act provisions from about 10 years ago that allow employers to automatically, that doesn't require, but it allows for employers to automatically enroll their employees in a plan. We've seen some real benefits, but not everybody's taken advantage of that. Greg, would you like to provide some color on that?
Sure. As we think about opportunities for expanding coverage, we think about coverage, adequacy, and income as three key aspects of it. And expanding coverage really does center on the really small to medium-sized employer, generally under 100 lives. And we need to remember that oftentimes small businesses form, they still may be trying to establish themselves in the marketplace with their business and do things to be successful. But simplifying plan adoption through simplified government reporting, increasing starter tax credits for employers. We've done some research that unfortunately half of employers out there in the small to medium-sized marketplace don't realize that startup credits are even available to them. So I think we, the industry, plus government, could do a better job in really kind of reinforcing that and actually kind of strengthening that. Another aspect could be is to strengthen those credits for adopting best plan design practices at the same time, to really kind of drive the best plans possible, to put people in plans at effective savings rates with employer matches, and then cover that with safe harbor provisions from an employer to kind of simplify that process. Those kinds of ideas we think would help make adoption more readily and even stronger in the marketplace.
Well, and I know Prudential has taken a strong position on allowing small businesses to offer multiple employer plans. Can you describe a little bit about that?
Well, this is a concept that actually exists today in some instances, but our proposal here is to broaden it to create what we call open multiple employer plans that would allow small employers to essentially pool their purchasing power to create plans that are part of a model plan design with the best practices, as Greg mentioned, and take advantage on a broader basis of professional investment management and really get the benefits that a very large employer may have today. There's some changes needed from a regulatory and a legislative standpoint to enable this to happen. There was great progress made actually in the 114th Congress when the Senate Finance Committee introduced the Retirement Savings and Enhancement Act, and we would like to see very much that continue to advance in the 115th Congress.
Well, and we agree, and we were supportive of RISA, and I think that was one of the sad things about the end of the 114th Congress is that we had an opportunity to get that over the finish line. So hopefully we've got some good momentum for the new Congress and new administration. Lenny, I'd like to bring you into this because I know that Bob and you have really given a lot of thought and your team to the 401k. And let's be candid. There's some criticism that the 401k system is a failure. How do you respond to that?
Well, I respond to it the way Bill Clinton responded to criticisms of America. There's nothing wrong with the 401k that can't be fixed by what's right with the 401k. Reynolds' message, the book, which by the way is called From Here to Security, is not a status quo message saying things are fine, everything's wonderful. To the contrary, Empower Retirement does an annual survey, and looks at everyone's income and their comprehensive economic position. And we can segment the population into groups according to how are they able to replace retirement income. What becomes very clear when you look at that is that people that have access to plans at all are way better than, far more able to replace income in retirement, which after all is the purpose of the system, than people that don't have access. So closing that access gap and covering people is the first challenge. People with automatic enrollment in their plans are better than those that just have plans. People with automatic enrollment plus savings escalation built in are better still. So at the top end of the spectrum, full automaticity and reaching 10%, the goal that Financial Services Roundtable endorses, 10% savings rates, I mean, those people are on track to replace, I don't know, 110% at the median of their working income. They're actually ahead. And the media tends, in general, as a former reporter, if it bleeds, it leads. So the tendency is to look at the shortfalls and the failures. What we want to suggest is let's look at the successes, and then let's spread those best practices and successes system-wide. If we do that, we can substantially solve the American retirement challenge with existing mechanisms, with a solvent Social Security, plus, did I lose my mic?
Speak up, I think, is what they need you to do.
Pass the mic to them. Thank you.
Excuse me.
Microphone.
Is this on? Yeah. If we spread the best practices, automatic enrollment, automatic savings escalation across the system, and begin to include some lifetime income solutions within plans, we can solve this problem. Now, that's not to say the system as it exists today is perfect or as good as it could be. What it is to say is the structure of 401k can be optimized and help to solve America's challenge. Blaming the 401k structure for saving shortfalls is akin to blaming the idea of a bank account because people didn't save into it. And when you make it automatic, people like it and they go with it and they succeed.
Chris, you're nodding.
Yeah. Well, I mean, first of all, just to pile on a little bit here, I know EBRI has actually done some research that shows that individuals who are in an employer-sponsored plan are 16.5 times more likely to save for retirement. It is a matter of enhancing what we have. Again, EBRI has done some work that shows with the retirement security projection model, the benefit of these automatic features that have only been in place since 2006. So you have to remember that the 401k system was originally designed to supplement, to be a supplemental retirement plan, not to be the primary vehicle. It is now the primary vehicle. And so it's a matter of recognizing, bringing the best practice plan design into it, and reframing it as a retirement income plan, not only a retirement savings plan, because that is what it's going to do. It's going to finance, it's going to create a replacement paycheck for many people in addition to Social Security and retirement.
Well, and, there's some data that came out in the last couple of years saying that, the majority of people under 30 do not believe that they're going to be able to rely on Social Security. And just a few months ago, we had the two co-chairmen of the Bipartisan Policy Center, Kent Conrad and Jim Lockhart, here talking about their recommendations. And, what they have found is that, it's that within the next 20 years, Social Security is going to have a 23% across-the-board cut for all beneficiaries unless something is done. And so it really is critically important that we get people thinking about taking those steps early. Mm-hmm. But we use words like retirement when someone is 22 years old, coming out of college. Earlier in a conversation we were having earlier today, you were talking about brain science and how people don't really think about things that are going to be that far out. Can you provide some color on what do we need to be doing to get people to think about this issue differently?
We were talking earlier about the fact that the human brain actually does not, when an individual thinks about themselves 20 or 30 years out, the part of the brain that lights up is the same part of the brain that relates to a stranger. So They don't recognize themselves 20 or 30 years out. We've actually done some work with visualization technology so that people can see themselves 20 or 30 years out. And we see increases and contributions to employment plans when we do that. So part of it is just, it is literacy. It is using new techniques. It is talking to them about the incentives that are there for them to save. Again, with millennials, just as with individuals who are farther along in their career, if you can give them the psychological boost of saying there is a tax incentive here for you to save for your future, it does.
And Greg, last year, as part of the Financial Security Coalition, which all three of your companies and many other FSR members are part of, we had an event here talking about the sandwich generation and the challenges that they have. And of course, and that for many of you who might be familiar with that term, that's those of us, and I include myself, that, taking care of children, taking care of parents who weren't prepared, trying to save for my own retirement and my family's own retirement. There's a lot of pressures today. And so as folks are trying to figure out how to manage those pressures and what to prioritize in their personal lives, from your point of view, how do they need to be thinking about this? And then as a second part of that question, how should policymakers be thinking about this?
Yeah, that's actually a very difficult topic because there's some really tough realities for people
who are trying to support elderly parents and young children and work through and invest and so forth. I think there's some brutal facts, and that's that sometimes we have to take a look at our own situation and plan and prepare as much as possible and assess our situation and try to make the best of it going forward. I would echo, though, a couple of comments made earlier that building upon the employer-based system from our point of view is absolutely essential. It's easy to pick on the 401k system if you want to be a skeptic to say it has not worked. I shudder to think where millions of Americans would be today without the savings in the 401k system. As a comparison point, those who don't have access today but do have access to individual IRAs as a pre-tax savings vehicle, less than 1 in 10 Americans today is taking advantage of that. So I think that tells us that we actually don't do a very good job of preparing ourselves, but we do a much better job when we are able to leverage the support structure of our employer, who plays a critical role. So I'm with Chris and Lenny in terms of we need to build on the system. There are things we can do better, but that is, I think, a really key place for us to go.
Great. And I'd like to stop there because I know we have many folks in the audience who might have some questions. And so if at any point you would like to ask a question, feel free to raise your hand and we'll be happy to take a question. But I would like to build on to, what people are willing to do on their own. And some people think, I don't need an advisor. I don't need help. I can do this myself. I can manage this myself. Is that the right strategy? Lenny, would you like to provide some color? Pass down the microphone to you.
Sure. No. I think there's pretty good data that shows that people that have access to advice on the same lifetime income survey that we do at Empower do better than people that don't have access to advice. But there's even better data coming out of Canada. I recollect that I don't have the study tip of tongue, but people that have consistent advice over a decade start to have like twice as much savings as people who don't. And I really don't think it's rocket science because if you think about what advisors do, is there a single financial advisor in this country that approaches a new client and says, gee, you're saving too much. Why don't you take out some more credit cards and go to the Caribbean? So obviously, their basic advice almost always is to save more. And then they say, well, put all your money into tech stocks. No, they say diversify. They say when markets are crashing, don't panic. When markets are topping, they say don't get giddy. Don't borrow extra money and buy more stocks with a PE of 40. So advisors just, by definition, help people do the right things, and consistent dealing with them has a demonstrable effect that's very powerful.
Thank you. And building going on with the chairman's comments earlier and the goals to really simplify, because if folks are trying to do it themselves, it can be complicated because it's not simple enough. But then if we simplify too much, is that the right direction as well? For instance, in the blueprint, I know that they talk about the idea of universal savings accounts. And so one of the ideas behind universal savings accounts is that there would be no tax penalty if you pull the money out. Is that a good strategy, Chris?
It is a complicated topic. I mean, on the one hand, we see individuals who could benefit from having a savings vehicle that allows them or helps them manage, I'll say, just the day-to-day. Unfortunately, what we see in the retirement plan system sometimes is people using their retirement plans as a checking account, and that is not good for them on a number of different fronts, from a tax standpoint, from a savings standpoint, and so forth. I think we know enough about human behavior now that should probably be taken into consideration as we design some of these things and think about what we're trying to solve for as well. Be very intentional and thoughtful about what we are trying to accomplish. Short-term issues are very different from savings for long-term, and we need to think about it in those buckets.
Greg, you're nodding. Would you like to add some color to
that? Yeah, I would echo that. I mean, the current system we have is a little bit of a carrot and a stick, and I think that formula is necessary to make sure we're providing the right incentives for people to save, and the right incentives for people to keep dollars saved on a long-term basis. But there is a liquidity component associated to it. One of the things we see too often is that individuals are taking multiple loans out of plans, and there's things we could do to help our employers think about different plan designs to kind of limit that some more. But I do think the reality of it is there's going to have to be a balance that we're going to maintain in that situation, because people want that component available to them a little bit.
Lenny, look, you have something to say.
Yeah, I would say that having some ability to borrow against your account it encourages people. They, when they're required to lock away their money for their entire life, it's a little inhibiting. And the anecdote I would mention is from my old employer, Fidelity Investments. Ned Johnson, back in the day, agreed or came up with the idea of making money funds checkable. You could write checks on them. And the rest of the industry thought he was insane. Why would you let them out just so easily? What happened was billions of dollars poured into Fidelity because people knew they could quickly re-access that money. So if you absolutely shut down access to loans or hardship issues, I think it discourages people from putting the money away in the first place.
I'll start off. Well, all of you, fantastic job, and I thank you all for your very candid and thoughtful remarks. All of you addressed several points, one of which, of course, is the importance of 401k and employer-sponsored plans and automatic enrollment as a mechanism to increase retirement savings. You also addressed sort of the deficiencies of IRAs, where you have about a 10% participation rate, and probably among those who are participating is going to be higher income people who do a fairly good job already. Having acknowledged both of those points, we are confronting in the states a number of proposals that would create their own retirement plans. State-sponsored retirement plans for employers that don't provide them, and we have fought against them. At the same time, we've also recognized our own deficiencies in not necessarily serving that marketplace. So you have this incongruity, and how would you reconcile it?
This is why we are so supportive of the multiple employer plan concept, a construct that could be used across, every state, so that we would not have a patchwork of different structures. And it does contain all of the elements that we have seen work in the 401k system. So that would be our recommendation would be that would be a more efficient and productive way to solve that issue.
Yeah, I would concur with that comment on open MEPs, multiple employer plans. That's an avenue to expand growth, especially for the small to medium-sized employer. We're comparing a little bit of apples and oranges in some of the state plans. Many of those are based on kind of mandatory models versus voluntary models. We need to take that into account. The other thought that comes to mind as we think about this is if as those proposals form, we have to be conscious about how that may encourage or discourage employers to step back from their sponsorship role. Their sponsorship role is critical. They provide a fiduciary standard, they provide the best interest of their employees, they review plan designs, education services, fee structures, and so forth. They play a critical role. I think it would be a tremendous step back if we designed a model that somehow discouraged employers to continue to sponsor on behalf of their employees. And so that's another component I think we need to take into account.
Great. Well, as we all know, we have a new administration this week, and new Congress as of a couple of weeks ago. But I don't think it's a big secret that when everyone was on the campaign trail, that retirement security was not something we heard a lot about. But we all know how critical this is. And so I'm going to ask each of you to answer this one, but I'll start with Chris. If you could give any advice to the Trump administration and to the new Congress about this issue and why it should be a priority, what would that advice be?
To the points we raised earlier, this financial security is the whole retirement system is a core component of financial security. It is an issue. It will continue to be an issue unless we take action to ensure that people do have the right mechanisms and access and capability to save. And the private retirement system can be that vehicle. Again, very encouraged by Chairman Brady's remarks. I think they're on the right path. Really looking forward to working with him and members of Ways and Means to continue that journey. But I believe the private retirement system can do what needs to be done here to ensure meaningful retirement outcomes for individuals.
Okay.
The chairman was very clear this morning that savings drives growth in our economy, and it is a stimulant for growth because those dollars have to be reinvested in the economy to help drive growth, and so it is a growth component, not a tax expenditure. The second portion of it is, in one way or another, we're going to have to pay for long-term retirement for individuals. We have markets around the world that are trying to emulate what we do in the United States through an employer-based voluntary system to supplement that. They are envious of the model that has been created here, and they are asking us every day, how do we create the right structure to help drive this for capital growth and also to take pressure off of the public system from that point of view. And then the third comment would simply be, these are deferrals, not expenditures. Let's not mix that conversation up with others as we have this conversation.
And Lenny?
I would simply advise him that when you look at polls, financial anxiety of running out of money in old age is one of the greatest concerns the American people have, A. And when you look at polls and study what is their attitude toward workplace savings, you find that 401ks and IRAs are very popular, and that large chunks of the working class base that voted for Donald in the Midwest lack access to these plans, and that one great thing you could do is work to close that coverage gap, whether through MEPS or some kind of revival of the auto IRA concept, which Bob Reynolds was supportive of. Extend the coverage to more workers. It'll pay off economically, and it'll pay off for you politically.
Do you have any additional questions from the audience? Yes.
Universal coverage, there's still this issue of tax deferrals not reaching all Americans. So if you don't have income tax liability, for example, low income folks, I'm curious what the panelists think about having incentives reach those folks who the tax deferrals don't touch, either through a refundable savers credit or some other means.
I would just offer one or two comments on that. As I think we've looked at where the tax expenditure, the tax deferral incentives today are, frankly, they're rewarding, 80% of them are rewarding individuals with incomes under $150,000. So the primary incentives that are invested today really are reaching the middle class in terms of how they're utilized. Specifically to your question, are there other things that might possibly be done to help through savers credits and so forth? That's certainly a possibility, but I just want to kind of emphasize that I think most of those dollars today are being utilized by individuals that are more in that middle class.
And there was another question back here. Okay. Well, with that, I know we're nearing the end of our time, and so I want to give you all just a couple of minutes each just to talk about why this is such a priority for your company and any closing thoughts from your perspective.
Well, first of all, I want to thank the Financial Services Roundtable for sponsoring what I think has been a really important discussion and conversation. You know, we believe we have a real sense of purpose about helping people grow and protect their wealth and have the capability to retire with dignity and independence. And that's what this is all driving for. And so we will remain very active in the conversations to come with respect to the contribution that the any tax changes and other kinds of reforms can have to continue to advance the ball.
Yeah, very simply, our global mission is to help people prepare for retirement and invest for long-term retirement savings so that they find themselves in a position to have a dignified retirement from that perspective. I was very, very encouraged by the chairman's comments this morning. It was very, very encouraging to hear that. But we recognize that we have to continue to be able to provide solutions about how to improve and enhance the system. And also, I would like to say thank you to the Financial Services Roundtable for sponsoring this event today.
Yeah, I'd echo that. Thanks to you. And thanks for the support on the Save 10 campaign all along. I mean, I guess that Bob Reynolds, approaches this retirement challenge as a basic part of American social contract, that after a life of work, you get the option not to work. You choose your own form of retirement, but you can't do that without resources. So supporting people early and helping them get started is the best way to do that, for the reason that the capital markets over 10, 20, 30, 40 years can be invested in ways that are reliable and that will help people have the dignity of supporting themselves in old age. And we believe that individual solvency reinforces national solvency. They should never be pitted against each other in the tax reform process. And frankly, this country's values are such, we're not going to let old people starve to death or die at the door of the emergency room. So let's find the best ways to enable them to have resources of their own. And of course, we'll have to, in emergencies and late in life, we'll have to cover them. But let's let them have the dignity of saving their own assets, watching them grow, and being able to meet their own expenses. So it's a business issue, obviously. The bigger the market, the better for our business. But for us, it's an moral and emotional and political issue too. So let's get it right.
Well, thank you. Well, Lenny, Greg, Chris, we appreciate your time this morning and your great insights. You all have made significant contributions to financial security, the financial services industry, and certainly retirement security. And so we appreciate all of your contributions and your continued engagement. And we appreciate you all joining us this morning, and Chairman Brady for joining us to give his thoughts on a topic that is top of mind for many of us, looking at the agenda for 2017 and how we can continue to drive prosperity and growth. And so on behalf of Governor Pawlenty and the Financial Services Roundtable, thank you and have a great morning.
Thank you.
Hey, Bob. How are you? Take your bullet.
Greg?
This is top bus. We don't cross any people. What do we know? You all right?
Nice to see you. You know what? I don't right now. I had to leave all of my stuff away in the back, but Josh is.
Let me bring you over. He's a great guy. Oh, thank you. Oh, there he is. Lenny, how are you, buddy? Hey, thanks for the book. I got it in the mail. You got it. You did good. Yesterday.
I got to grab my
Henry, I had sent you Limra, and I sent you the note last week or so about.
Nice to see you. Thank you. I'm just going to grab this. So it's got all my millions in it.
Great job.
Thank you.
Hey, Bob. Okay.
Great. And
You an old friend of mine?
Yes. How did you know?
Send me an email and say you did a great job preaching the gospel of Bob, and I'll forward it to him.
How did you know I was a good friend of Bob's?
I just kind of guessed.
No.